Welcome back to the Dividend Diplomats YouTube channel. You got your boy Bert, and you know you're rolling with Lanny, the Dividend Diplomats. We're back in the flesh to talk to you about dividend stocks to buy in October of 2021.
But before we do, subscribe to our channel if you haven't already. Give this video a thumbs up. Thank you everybody for the support so far. We are pumped to continue bringing you dividend news, dividend analyses, and dividend stock watch lists like this. So we are pumped up today. Lanny has put together, he did some research, he pulled up, brewed some coffee, he did some detailed analyses, looked through some earnings releases, and found 3 dividend growth stocks to talk about and feature this month.
Yes, it's all about buying dividend stocks here on this channel. We buy dividend stocks because it increases that dividend income amount, which is, we think, is the best form of passive income on that journey to financial freedom. The S&P 500 this past week, to wrap up September and enter October, was actually down overall by about 2%, Burton, in the overall market.
That's right, and I feel like every week we've been talking about how the S&P 500 is hanging around 4,500. Not the case today, as they are below 4,400 and right in the middle in the 4350s-ish to end the day. It's been interesting to see how the market's coming down in these new opportunities that continue to present themselves.
Yeah, from dealing with, obviously, the budget discussion, the government shutdown, the Delta variant, inflation concerns.
Yeah, there are definitely some headwinds that the market's facing as we try to figure out where we're going to go, what's going to happen next. But none of us have a crystal ball. We'll be the first 2 people to tell you that. And anyone that does, you should probably unsubscribe from that channel and start finding someone that will help you learn to look at the fundamentals. Even with those headwinds, we are still finding these stocks to buy, and we're still running companies through our dividend stock screener.
So with that, we have 3 dividend stocks to buy right now. And in fact, these are 3 dividend stocks that I hold in my current dividend stock portfolio.
I own 2 of them.
Bert's 2 of 3. Hey, you're in the Baseball Hall of Fame if you bat 2 of 3 for your whole career.
I'll take it.
He'll take it.
Also, I want to make a note here, everybody. One company that we have always talked about is not one of the 3 on here. So Verizon's not on this list here. So I know they've been there because they continue to show signs of undervaluation. The 3 companies have not been featured for a while. They're new, and it does not have Verizon.
Right. Verizon's not on this list. Pfizer stock is not on this list. AT&T stock is not on this list. Bert's favorite king, J&J, is not on this list. Johnson & Johnson. We're going to just completely sidestep here into these 3 dividend stocks, which I'm sure many of you wouldn't even anticipate that they would be on this October 2021 dividend stocks to buy watch list. So to get in, before we do actually, we always run them through the Dividend Diplomat stock screener, which focuses on 3 dividend stock metrics, 1 being the price to earnings less than the S&P 500, 2 the dividend payout ratio, speaking to that safety of the dividend, preferably below 60%. But Bert, what's that perfect payout ratio?
40 to 60.
And what's that 3rd dividend stock metric?
Dividend growth history, where we look at the 5-year average dividend growth rate and how long a company has increased its dividend. And then for a good measure, we throw in a bonus metric of the dividend yield. So Lanny, are you ready to kick this one off?
Let's kick it off. Let's peel off the Band-Aid. Let's get into that first dividend stock to buy right now. And Bert, we're going to head down 71. We're going to stay in Ohio.
That's right, Cincinnati, Ohio.
For all the haters out there, yes, we are still sticking into the hometown state.
Who day.
Oh boy. Give us a thumbs up too if you're from Ohio or from the Midwest. But we are talking about Kroger.
Ticker symbol KR. The grocery store giant that is nationwide. Ironically, though, they do not have a presence in Northeast Ohio, where the Diplomat headquarters is. What's always fascinating about Kroger is they are, despite being a major grocery chain, they continue to fight Amazon. They continue to fight Target and fight some of the trends that have seen other grocers struggle. They did well in the pandemic. They made a lot of quick things. They made ordering easy, and their stock price has reflected all the positive stuff that's happened, hasn't it, Lanny?
They really have, and they're becoming quite the dividend growth stock. So to get into the metrics here, we're using the stock prices as of October 1st, end of day, Friday. Kroger was trading at $39.14. to speak on them, year to date, their stock price is actually up almost 22%, and year over year, they're up almost 15%. So they've been a pretty good performing stock from appreciation standpoint.
Yeah, no, I agree. And with that price of $39.14, their forward earnings are estimated at $3.33. That gives them a PE ratio of 11.75, well below the broader market, which is in the mid to low 30s at the moment as the market continues to come down.
So that was that first dividend stock metric, 11.75 PE ratio. To go into that second dividend stock metric, the dividend payout ratio on Kroger stock, they have a dividend that, when annualized, is at 84 cents per share. Obviously, spread that over 4 quarters. That equals an extremely low dividend payout ratio, Bert, at only 25.23%.
It's fantastic. It clearly crushes it.
What's that mean?
I mean, grocery stores, it takes a lot of capital. There are thin margins, so they're probably not going to have the highest payout ratios in that sector. But the dividend is safe. There's plenty of room to grow, and there's a lot of safety in that dividend right now. Moving into that third metric, let's take a look at the dividend history, and that's what I think we've probably been most impressed with Kroger over the years. They've become a very strong dividend growth stock, as you mentioned.
Oh, yeah.
Oh, no, you listen up to me, brother. Their 5-year dividend growth rate is 11.55%.
Oh, all right, Bert Hogan, mixing it up over here. 11.55% 5-year growth rate on average.
Yeah, and that low payout ratio too, so their earnings are growing, their dividend's growing, and it's safe too. They've increased that dividend for 14 consecutive years. So
solid.
Moving towards becoming an aristocrat, which is a company that has increased its dividend for 25 consecutive years.
Kroger's last dividend increase was earlier this year in 2020. Kroger actually increased their dividend 16.67%, so even above that 5-year average.
Fantastic. So let's round it out with a bonus metric. The dividend yield is 2.15%, well above the S&P 500's dividend yield, which is around 1.3 to 1.5%. You want to summarize Kroger, Lanny?
Kroger, again, to give you the quick hitter stock metrics on Kroger stock, PE ratio of 11.75, dividend payout ratio below 30% at 25.23%, dividend growth rate going on 14 plus years at that rate of 11.55%, with a nice solid dividend yield of 2.15%.
Let's see how dividend stock number 2 looks running through our stock screener, because number 2, you can actually buy in Kroger if you want to.
You can.
That second company is Hormel, ticker symbol HRL. It's been starting to get a lot of noise in the dividend community. You see a lot of people commenting on our YouTube channel, what about Hormel? What about this? We've seen tweets about it. We've seen comments on our blog about it. It's exciting when you see a dividend king such as Hormel start to show signs of undervaluation.
So Hormel was trading at $40.89 at the close of business October 1st. To get into the stock price, they're actually down year to date, almost 12%, while the S&P 500 is way up.
Interesting.
And on a 52-week basis, year over year, they're actually down even more. They're down almost 17%.
Wow. Yeah, no, their price is coming down. That's interesting. And because what always jumps out to me is they are such a strong consumer staple brand, which is why they've been able to become a dividend king. I mean, their brands crush it. Hormel pepperoni, obviously. You've got the Hormel chili. You've got, let's see, what else do we got on this list here, Lanny? Mbasa, Donna Maria. I'm kidding. Let's see what else we got
Justin's here. Peanut butter, the Jenny
Skippy, right? Don't they have?
They have Skippy.
Spam.
Bert's favorite breakfast, Spam.
Yeah, I just eat it straight out of the can every single morning.
And for those that want to get a kick out of it, they have Stag chili.
Oh man, that's a throwback. But the point with Hormel is they don't just have average, mediocre, bad brands. Their brands crush it. They are some of the top in their sectors, and they are recession-proof in the sense that when times get tough, you can always crack open some Hormel Spam and start eating it.
Wow, there it is. So Hormel trading at $40.89. To get into the Dividend Diplomat stock metrics on Hormel, again, ticker symbol HRL, that forward earnings projection is only $1.70, which equates out to a PE ratio of a higher 24.05, but that's probably around the range of something like Hormel, but they're still also below the S&P 500.
Yeah, and that's the key point here. They still pass the first metric even with a higher PE ratio. Metric number 2, their annual dividend is 98 cents. Divide that by the forward earnings, 57.65%. Nice check mark there as it is below 60%.
Nice. Look at that. A nice, perfect payout ratio in the range of 40 to 60% to slide into third for that third dividend stock metric, dividend growth. Bert, what is Hormel?
Their 5-year average dividend growth rate is 11.0%. I missed your cue of what you were saying. Yeah. They are a dividend king, which is a company that has increased its dividend for 50 plus years. They've increased that dividend for 54 consecutive years. So, hey, I missed you teeing up the segue there, but I caught it on the backswing when I was coming around.
That's right. So Hormel, dividend king, gosh, that's always a good ring to it.
Yep.
Hormel, when we get into the dividend yield's coming back up.
2.4%. Yeah.
Not too bad. Almost.
For Hormel, that's pretty strong. I've always considered them right around 2%, which is why I've held tight. They've been a little more expensive. Their yield's been around 2%. Now, though, when we run through those metrics, to summarize, a P/E ratio of 24, payout ratio that's perfect at 57%, that strong dividend history with the 11.6% 5-year dividend growth rate, and a yield of 2.4%, things are looking strong for Hormel. I'm very interested in this one. It's a nice dividend factor too, 2.4% yield plus 11.60%, very strong.
Yeah, now their increase during COVID for Hormel, when they increased their dividend, it was slightly on the lower side of their average at only 5.38% on that dividend increase. But again, think COVID, obviously they didn't probably want to go gangbusters on it. Payout ratio is getting a little bit on the higher side, so I'm curious what they'll do this November. It's also worthy to note as the last piece, according to dividendinvestor.com, that 5-year dividend yield average is 2%. So trade now at 2.4%.
Yeah, another sign of potential undervaluation. Interesting. Should we move into number 3, Lanny?
Bert, let her rip on number 3.
Well, I was just putting some of their product out on my yard here as we get ready for fall and winter. This third company is Scotts Miracle-Gro, ticker symbol SMG. This company just crushed it during the pandemic.
And we're still in Ohio.
Yeah, they are in Ohio. We haven't. Yeah, they are. That's right, in Marysville. Yeah. I keep forgetting Scotts is headquartered.
Scotts, ticker symbol SMG. We all know Scotts Miracle-Gro, currently trading at $147.14. Bro, how much are they down this year?
They are down 26.69%, which is fascinating. In their 52-week stock price, they've only decreased 2.39%. So think about that stock chart here of how much they just shot up in the last year to come back down.
Come right back down to earth.
Yeah, but...
Which it makes sense because they're a product that goes back into
but strong brand presence. A lot of people during the pandemic spent some of those, fixing their house, fixing their yards, getting things better.
Yep.
So people allocated the budgets they couldn't spend on traveling into their yard and some of those DIY projects, and Scotts was there to deliver.
We kind of always thought of Scotts as well, which it's hard to see within the metrics. Is they're like the king of the special dividend.
They are. It's funny because every few years they just announce this massive, massive special dividend, which is great because they also announce strong dividend increases. I think they increased their dividend in July about 6%-ish, Laney. I think that's right.
Yeah, I think that's right on the dot.
Yeah, so to prove that point though, in 2020, out of nowhere, they announced a $5 per share special dividend.
Gotta love. Sometimes, you gotta love that. You don't really factor that in the analysis, but I would say once every 3, 4 years, 5 years, they'll throw in a massive special dividend.
Yep, which will be interesting to see when we start looking through the screener, see their dividend, what their growth rate is, and what their yield is, which doesn't necessarily factor in that special dividend that you're going to get every few years.
It might be factored in on the dividend growth rate.
Oh, okay.
But
we'll see.
But again, you don't really factor that into the overall dividend that you get.
That's fair. Okay.
But hey, let's get in the first metric.
Yeah, let's dive into metrics and we'll see how that was factored in. P/E ratio, their price was 147.14. Earnings per share, $9.18. P/E ratio, 16.03.
Solid.
Yeah.
That's solid. I know you and you've brought them up recently. Really want them to get to a metric point that we'll talk about later, but yeah, very good price to earnings ratio.
Yeah, metric 2, the dividend payout ratio, annual dividend $2.64. Divide that by the earnings of 918. That gives you a payout ratio of 28.76%.
Wow.
Think about that, though, for a second. Their annual dividend's $2.64. Last year, that special dividend was $5 per share. So the special dividend was double their annual dividend. It's insane.
Nice. Going into the dividend growth rate for their third dividend stock metric, they've increased their dividend consecutively for, I would say, at least 11 plus years. Their average rate, because of these special dividends, during that kind of boost up that average growth rate. It's at 36%.
Yeah, insane. Yeah, now you're right. It is factored into the dividend growth. I didn't realize that when we were going through it, but even without the special dividend, they're still increasing that dividend annually on a high single-digit mark too, which is great.
I would agree. And I get into that bonus metric, the dividend yield on Scotts Miracle-Gro. Again, paying $2.64 currently on a 12-month go-forward basis, dividing that by the stock price of $147.14. Scotts Miracle-Gro dividend yield right now is 1.79%, which is above the S&P 500.
Yeah, so to summarize, P ratio 1603, payout ratio 28.76, strong 5-year DGR of 36.04, increase for 11 years, and a yield of 1.79%. So Lanny, these are the three companies that you were going through your watch list. Talking through them now, how would you rank them as we go forward into October?
Wow. Honestly, all three stocks are fantastic. You can't go wrong buying any of these three stocks. There's a reason why they've been here, been increasing their dividends through difficult times and in good times. I think it's going to depend on what your portfolio looks like. Personally, Scotts Miracle-Gro kind of ranks one on my list because I just don't have much of that type of industry.
That's fair.
I just don't. But then coming in a hard second, because my position is smaller than what I would have liked it to be, is Hormel. And then third is Kroger. But again, I'm looking to buy a combination of all three of these dividend stocks.
Yeah.
What about you?
So I'm really liking Hormel right now. It's something we don't have. I'd like to either build in my wife's portfolio. Maybe that's where we'll start a position for my wife and her portfolio, focus on those long-term strong dividend growth stock. Just a nice consumer staple to do it. We don't have it.
You got the peanut butter, so you might as well get the pepperoni.
Yeah, nope, I'm there with you. Who doesn't love peanut butter spread on top of their pepperoni? But I would say that's a 1A. And 2 1Bs are going to be Kroger and Scotts Miracle-Gro because the metrics for both of those are looking great too. So 3 great companies. If I had to pick one, I'd say Hormel, but the other 2 are close behind it.
So what stocks do you think out of these 3 are ones to buy right now? Are you already buying these stocks right now? Let us know in the comments. If there are other undervalued stocks, share them below. Obviously, we have a long list of dividend stock analyses to get through as well in future videos. So definitely subscribe to our channel so you don't miss any of those. Give this video a thumbs up as well. Bert, any parting words?
Let's send them off, Lanny.
That was Bert, and this is Lanny from the Dividend Diplomats.
Over and out.